Good morning, everyone. Once again, Thursday morning at 10 a.m. What's this today? 29th of September today, almost another quarter done. Nice to be back with you again after being on the road last week. So you can see we've got a new holding slide showing a number of projects. So just for a bit of variety, is always good. So big welcome to our special guest today, Wendy Sneddon. How are you, Wendy?
I'm great, thank you.
Looking forward to the conversation. It's going to be really informative, I think, and very beneficial as we look at our special topic today. So great you could join us. So kicking off officially our sort of first slide, as we call it, just in case there are those who have joined the broadcast for the first time. You may have been invited on, not exactly sure what this is about. This is a 30-minute or thereabouts weekly broadcast that we do 10 a.m. every Thursday. And it's designed to give a brief overview of the market. We have a special guest most weeks, and we dive into a topic that's relevant to anyone involved in the world of property. Sometimes we'll look at some projects that are on our platform, but above all, it's about educational tips. That's the value point that we try and provide. My name is David Johnson, CEO of Leo Crowdfunding, equity property crowdfunding platform, and my special resident co-host is
John Corey, Property Fortress. Welcome, everybody. Long-term landlord, US, UK, long-term as in I earn the gray hair, and generally a foil to David's sort of like crystal ball optimism.
Yeah, you have to have both. I think it's about time the crystal ball actually got back onto a slide, John, actually, especially now with all the upheaval in the UK economy and the world economy. I think
this is funny. You pick the no one saw this coming to say, oh, we should get back to predicting.
Yeah, exactly. That's part of the fun of it, though. Part of the fun of it. We had an interesting conversation last night on WhatsApp about leadership and conviction and belief, and it was, no one knows the future, but people have to try and make best guesses, which we'll get into in a few minutes. So straight into one slide before we go straight to our guest, and that is the market update. I think it's always important just to kind of update on what's actually happening, or any big events that are affecting the property market. And I suppose in the UK, the big one at the minute is the new Prime Minister and the direction that she is taking the economy with some of the decisions she's made. But specific to property, obviously in the mini budget, stamp duty cut, and then the big discussion is, will this sort of spur on the housing market or not? So I know, John, you're an avid reader on these things, and you like to sort of analyze the different impacts things can happen. So what's your take on the current market and what this latest development may impact?
Well, the stamp duty cut has little to no impact on most of the UK. Most of the UK isn't even paying stamp duty, or will be paying a small amount of stamp duty. This is not like a major shift. The fact that the interest rate went upward because of the same announcement, but not stamp duty part of it, says that what I think I gave you in a discounted stamp duty is essentially rounding error, and you just won't be able to afford to buy. So much for that stamp duty cut.
But what about, though, the situation with during COVID, the stamp duty became this lever, if you will, or an incentive that will cut it. And then we end up with, like, when it was coming to the end, you had this artificial spike where everyone was moving to do transactions because the stamp duty holiday was going to finish. The fact this is permanent, do you not think that will maybe bring some stability, that it's not just a short-term lever and having an artificial impact on the market? It'll maybe be stabilized?
No. I think it gets priced in very quickly. What might have been useful is if you had the old rate next to the new rate. It's a change, but it's not going to be that big of a difference for most people, particularly first-time buyers, regions of the country that fall below the stamp duty threshold or barely touch it. There was a news broadcast on Stoke-on-Trent, and how most of the buyers there never pay stamp duty. So the fact you cut something they don't pay doesn't matter. the upper end of the quote Stoke market might get into the 250 range. So fine, it affects them, but it's not necessarily that important. What is going to slaughter people is if interest rates go up by 1% or something. That's like 25 years of pain versus, okay, on the front end, a one-time payment.
Okay. So I think the takeaway from the broadcast today is that they'll send a recording of the broadcast to our new Prime Minister and say that John reckons no impact.
Down to her ex-chancellor. So.
Exactly. Well, Wendy, you're obviously based up in Scotland, so this doesn't affect you, obviously, materially at this stage. But what's the take up there in terms of what the government may do?
Yeah. We don't know yet. There's been lots of speculation. Some say that she probably won't do anything. So we're just really waiting to see.
Which she?
Nicola Sturgeon, our lovely First Minister.
Okay, so we
don't know.
Yeah, so it's almost like a waiting game.
Yeah, but I think for investors, it's good if you're investing in properties in England. There's potential reductions when you buy, but I don't think it will be balanced out. As in, the interest rates are going to be the biggest problem, as John said, and I don't think this really balances out that at all, because you only pay that once, so that discount's had if you've already owned the property.
Yeah. I think we'll definitely have a discussion on interest rates over the next couple of weeks, and it is amazing that we've had such a long period of time with such low interest rates, which in itself is artificial in some respects. And now all of a sudden interest rates are going up. There's this like unbelievable reaction of fear in the market, and it's like, if you know anything about property and the history of property, where interest rates have been, is just like, that's just crazy. It was never sustainable. It was always going to change at some point. And it's like, why were people not prepared for it to change? Because it had to change. It couldn't stay at that at those rates. So
I bought my first house in 1990, and the interest rates were 15%. So I'm hoping it doesn't go.
Ouch. Yeah.
However, I was able to borrow 110%, so I was able to borrow enough to refurbish the property and then sell it on at a profit. So yeah, there was good and bad things about the 90s.
I think, John, what we'll do is maybe next week we'll make that the marked update of interest rates, because there's no question that people who haven't thought about interest rate rise are going to be caught. I mean, the news, particularly about people who took mortgages out.
Don't go into it now if you want to do it next week.
So I think we should do it next week, because it's going to be very interesting. So that's grand there. If anyone's any comments on this, of course, put them into the Q&A. And if you have any comments then for Wendy regarding the topic today, then again, get it in the Q&A and we can involve you in the conversation. Might be a question, might just be a comment, then great. Please do that. So let me hand over first of all to Wendy. Again, thanks for coming. Give a quick sort of overview on your background and your current business.
So my sister and I went into business together officially about 6 years ago. We set up Forget Me Not Properties, and we create spaces where great memories are made. We love taking empty properties and bringing them back to life. And that's what we've kind of been doing. But we're now about to take a step outside our comfort zone and do something pretty amazing.
Good introduction. And your background pre-property and your background of Karen?
Yeah, so I've always done property, as in we've always bought properties, done them up and lived in them, and then kind of sold them on. So it's always been an interest. But prior to that, I've been working in business coaching and leadership and management roles, delivering training and things like that. And Karen works for the NHS and has done for 30 odd years, but she's been a landlord since 2005. And we gradually kind of came together and said, let's do something. We had a piece of land and we built 3 houses on it, and we gave my mum one of the houses, and that kind of sparked our interest in kind of taking things forward. I mean, we did the wrong way around. We started with new builds when we really should have started with the buy-to-lets. But that was a baptism of fire, and we learned a lot during that journey. So
I bet. We're say you're bound to have learned a lot. I can imagine that. That's like jumping straight in the swimming pool without any swimming lessons. Yeah, you can get wet very quick and learn how to swim very quick. So
Yeah.
brilliant. Okay, no,
Yeah.
thanks for that. So this project that we're going to discuss, it is a project that's now on our platform as View Deal. But the topic today is really around this sort of structuring complex deals. And I suppose, interesting full disclosure, you attended our boot camp that John and I ran. You then decided to take some consultancy. So we've had many hours, the three of us with Karen as well, discussing the really complex nature of this project. And that's why I thought it'd be just interesting if some of those discussions, if you like, were used as education for the audience. So do you want to maybe first you sort of explain what exactly is the project, and then we'll dive into the complexity around this structure?
Yeah, sure. So some of our properties are serviced accommodation, and we really enjoy that side of the market. And so we've been looking at kind of starting to look at bigger properties with maybe more serviced apartments in one space. And through a very kind of convoluted route, we ended up meeting the owners of this property here. And so it's an off-market deal, and it's a 12-bedroom house, which also separates nicely into 3 smaller properties. So we've got the flexibility of renting out the whole house, or we can rent it out in 3 separate properties. Now the house is absolutely immaculate. It doesn't need any development work, which is kind of not usually what we would go for. But it's a 12-acre site, and as you can see from the picture, there are areas around the site that we could develop, and that was what was attractive to us, was the ability to have it income generating the day we buy it, and then to be able to look at the kind of future potential of developing the site further. It's near Inverness, and Inverness is a real hotspot for tourists 12 months of the year. So we've got the skiing seasons in the summer, in the winter, and hill walking and things in the summer. You're not far from Loch Ness. Inverness itself is beautiful, and you're also at the gateway of the Highlands for exploring Scotland and its beautiful surroundings. Lochs, golf courses, you know, I think it also lends itself nicely to providing yoga retreats or business retreats, that kind of thing. So that's one of the areas that we're going to be exploring.
Excellent. Okay, John, anything you want to say by way of sort of summary before we dive into some of the points?
I'm happy to just go along with the flow right now.
Straight into it. So I suppose the first thing, Wendy, as you've already indicated, this wasn't just like one plot of land with one asset on it. It's you could call it 3 different plots, essentially in one purchase stroke one deal. So when you looked at it, what was the thought process about potentially dividing them up, or like how did that come about? But in terms of that starts the complexity. Then if you go down a certain route of dividing it up, then we're starting the journey.
Yeah, so I mean, for us, it was a big step to kind of purchase a property of this size, and so we spent a lot of time considering how that we would finance something like this. And we kind of got caught out when we built the 3 houses years ago, because the plot was attached to our property. And when it came to splitting the titles after we'd built the houses and kind of releasing equity from the properties, it became very difficult for us to do. And so we learned from that to really think ahead in terms of how we might prepare this. So when we went to look at the site, we knew straight away that there was opportunity to put holiday lodges around the fishery. The fishery itself is a business. And actually, whilst it looks lovely all together, you could separate those 2 sites quite nicely. And also there's a kennels building, which has planning permission to be converted into a cottage. And that's the yellow plot in the corner there. So there were kind of 3 parts to this project. And so what we decided to do was speak to a surveyor and look at how would they value it if we were to separate it into 3 lots, focus the purchase on the house, and still quite a lot of ground comes with the house. And if we were able to kind of buy the site that way, and then we would have essentially the other 2 sites would then be unencumbered assets. And that was kind of the thinking. So that would allow us to then leverage further when we want to develop either side of those sites. So that was kind of the thinking behind it. It was let's find a really clever way to, protect these areas and be able to use them in the future.
And did yourself and Karen take any like third-party professional input on the potential opportunity, particularly of the 2 additional sites? So the green bit in the middle obviously has the asset. It's a service accommodation. It's operating, so you've got income.
Yeah.
But the overall value of the project really lies in the development opportunity of the orange
Yeah.
and the blue. So
Yeah.
did you do that yourself, or did you take professional input on that just to understand the potential, but also the challenges there may be in developing those?
Yeah. So, I mean, when you go to the site, you can, we both kind of had a feeling of what it could look like in the future. And we kind of took that vision and we met with a local architect, and that architect connected us with a planning consultant who previously used to work for the Highlands Council, and tourism is needed in this area. So we spent quite a bit of time with the 2 of them on site, kind of discussing potential, and that there are lots and lots of different things we can do. So they've kind of gone away to really think about what, because it's such a lovely site as well, we don't want to overdevelop too. So we want to make sure that whatever's there is sympathetic to the area and is right for the service that we want to offer. So yes, we took advice from people who knew the area, who knew the property, and who have experience in developing sites like this already. And it was on their suggestion, that's how we split the sites. They did the drawings for us, and we spoke with our surveyor as well, who kind of agreed on the sort of valuations for these areas as well.
Okay. And John, then regarding sort of beginning to structure the deal, then what are some of the, if you like, the factors to be considered when you start to split title and get into that type of a structure?
Well, I think there's 2 ways to answer that. One is the general comment, and Wendy touched on it before. You have to think about where you're going and straighten out the titles early enough that it doesn't constrain you or doesn't sort of put you in a box you didn't intend to be in. So on this one, the project, the intention is to split the 1 into 3 early, to then address them or look at them or tackle them as independent properties, which they would be then. And at the same time, they could have different development timelines. They could be funded independently. The green is being purchased with some bank finance, and it'll be secured. That loan will be secure with the first charge, but it's only against the green section of the property. So it leaves the other 2 pieces unencumbered. And while the slide says there's 3 opportunities, that's to Wendy and her sister Karen and the Forget Me Not Properties business. As something that's on the Leo side, I want people to actually read the documents, because it's not really 3 opportunities to the investors on the Leo site, because essentially the offer is only about the green section. That you need to read the document, understand exactly what's going on, what you're possibly buying into if you were to invest, and what you're not buying into. And it's all spelled out in the documents. I think the forum on the Leo Crowd Property site will be actually quite a useful place for people to post questions. You can ask about any of the 3 parcels. You can ask about the plans. You can ask about the financing. You can ask about a bunch of things. But if you want to post a question, post it in the forum on Leo crowdfunding for this particular project, and everybody will get to see the question. Everybody will get to see the responses, so investors can make a more informed decision on a project. I won't say it's complex, but it has a lot of moving parts, and you need to know what you're getting into and what you're actually not getting into.
Mm-hmm. And Wendy, how important was it that there was an asset generating income as part of the purchase? Was that a big factor in that you had an asset that was going to generate revenue day 1, as opposed to development that might come good in 2 or 3 years' time?
Yeah, I think it was it was really beneficial to the whole project that was the case, because it, you know, potentially allows us to self-fund some of the development maybe in the future using the income generated by the property. And it's certainly I've been starting to look at more assets where they are income generating. I think in terms of giving the bank confidence in what we're doing, all of those things kind of help.
Yeah. So we have a big plot of land. The strategy was then to do title split, end up with 3 opportunities from your perspective, 1 generating income day 1, the other 2 development potential that will involve planning, that will involve obviously getting that approved, market research to see what's the best thing to do with those. However, once you go down the route of deciding the title split, that then immediately bumps into the big challenge around the capital stack. And I think a lot of our discussions, and obviously John added huge value in these, and that is, you've got to work with a lender that understands the complexity of the different moving parts. And they're going to have some things that they're going to say, well, you know, these are the things that are non-negotiable in terms of our lending. So how did that, in terms of playing out, in terms of the structure then of the different SPVs, if you have 3 different plots of land, how have you put that together in making the SPV sort of a lendable entity?
Yeah, so I think we had to spend quite a bit of time thinking about what each company structure would look like. We worked with our solicitor to get those kind of created, and we also discussed with our accountant the impact of having the 3 SPVs and how that would work. The kind of funding for this is obviously very different from your kind of smaller buy-to-let type properties, and it's the first time I really experienced raising commercial finance, which was really interesting in itself. The commercial lenders in what you're actually doing. So the broker spent quite a lot of time getting to understand us and our journey and where we wanted to take this, so that he could then find us the right lender. And then when the lender came forward, they actually came up and met us on site and had a look around the project, got to know us a little bit, we got to know them, and that was really important for them in making their decision to approve the credit for this fund. So that was quite interesting, and we were quite worried at the time when the lender said they wanted to meet us, but actually it was a really good experience, and I think now we've got a relationship with them that, you know, going forward, you know, could be useful for us for potentially other deals. And it's quite an in-depth document we had to produce as well, so it was an interesting exercise in itself.
So the current,
as the loan, what is the loan secured against?
It's secured against the house and the land, the green section on the drawing.
So on this chart or this diagram, you're talking about purchase title 1, or
Yes.
what is that a fair representation? So it's only on the existing structure. This is not a construction loan. This is essentially buying something that already exists. And Wendy, the lender is lending on the value or the income stream?
They're lending on the value of the property. The income stream is how we're going to cover the costs.
Yeah. And so this is not a commercial loan in the normal sense that they're not securing it tied directly to the income stream. It's more what in colloquially might be referred to as bricks and mortar valuation. Is that correct?
It is, yeah.
Okay. So what is your plan? Do you want to operate this particular building or this particular site for income? And then what are you thinking you're doing down the road?
So the site there, yeah, it can pretty much run from day one. It's immaculate. With a little bit of furniture needs to go in. So we've already set up the management structure with Pillow Partners, who are our management partners, and they will basically take the bookings and run the accommodation. On the site itself, we're behind the house.
Actually, I didn't mean that end of it. I was talking about so you're going to operate the business and then you're intending to refinance, right?
Oh yeah, sorry, yes.
Yes.
Yeah.
Yep.
So we're the plan
we're
is
going to
to
go from
refinance.
residential to commercial.
Yeah, yeah. It's already classed as commercial because it was trading as a guest house pre-COVID, and even though they haven't traded for 2 years, it was still classed as a guest house.
Mhm.
But yeah,
But
we're gonna.
you weren't able to borrow as a guest house, in the sense that there's missing books and records, so to speak.
Yeah,
because they
we're
haven't
not
been
buying
trading.
we're not buying a trading business because it hasn't essentially traded for 2 years. So it wasn't.
Mhm.
Whilst we've done projections and we've done feasibility study on the area, so we know what we could achieve. And those projections have been considered as part of the whole credit application. But the lending was on bricks and mortar.
So this is what I like to call a residential to commercial conversion. So you're taking a property that's appropriately zoned or has appropriate planning designation, but essentially you're working from a residential valuation, building up 2 years of history so you can get a commercial valuation and end up with a commercial facility or commercial loan in 2 years' time.
Absolutely, yeah.
And what do you think that'll do to the value of the green project or the green site?
Yeah, so projections are saying that we should get a valuation of between 1.8 and 2 million.
So you're looking
But
for
it's
an
moved- it's,
uplift in value, right?
Yes, yeah, based on the business income.
Cool. So again, this is a residential valuation being converted to a commercial valuation. It takes 2 years to get some books and records to be established so you can get that track record so that a lender who lends on cash flow, lends on income stream after expenses can actually take a look at the property for refinance.
Yeah, absolutely.
Yeah. So I think that was really interesting because it shows you if you like, the journey. It's okay, we're going title splits, and then we've got an asset there, but is it commercial, is it residential? Actually, it's not trading, so it's residential, bricks and mortar valuation, but the value is in getting a commercial valuation down the line. So again, it just showed you the different moving parts of this, and the fact you had to, if you like, map this out as to where you wanted to get to in 2 or 3 years' time to maximize the asset. Okay, so any big takeaways for you, Wendy, before we wrap up? So any kind of big takeaways from the journey of trying to map out the best strategy for this asset?
Yeah, I think we spent a lot of time, Karen and I, thinking this through, and we probably wasted a lot of time before we actually made a decision. Then subsequently, the more people we got involved, the easier it became to kind of say, yeah, let's do this. So I would say, if you're looking at something like this, get the solicitor on board, get your planning consultant on board, and have a surveyor on board, and have a conversation about what you want to achieve. Because title splitting, not all solicitors understand it, and that was an interesting journey in itself. And so it's making sure that the people you bring on your team have experience of what it is you want to do, and are then able to really help you move forward.
Brilliant. Okay. Someone's commented here, I am interested in getting into deal sourcing. This has been a really interesting discussion to listen to. I am at the moment going through a residential sale. Thankfully secured our mortgage through before rates went up. So well done you. Someone else has commented, bought my first property back in 1989 at 16.6% interest rate. Wow. I said looking forward to the next. So yeah, that is that definitely takes the biscuit when it comes to interest rates. So as I said, this project is actually on our platform as the green part. If you recall, the commercial, or what would be traded as a service accommodation. So you can go to the platform. There's some thumbnails there. You click view deal, and you can download the equity offer document, as John's alluded to. You can again just cover some of the things were discussed today and go into the document and see those in more detail and see the journey. So this project is offering a projected 12% IRR over 36 months. And obviously it's very quickly going to be receiving income in terms of rent. So it's generating revenue, which is great. So if you have a look at our pitch pages, read a bit more from the document about Wendy and Karen and this project, and if this is something that you think, yep, I'm interested in this, then of course you can leave your email address and an amount that you may be interested in investing once you've done all your due diligence. And that just puts you on the list, if you like, to be kept in touch with this project. And we're planning a project webinar, Wendy, next Tuesday night at 7 p.m. I believe, isn't that right?
Yeah, absolutely, yeah.
So there's going to be go ahead.
I was just going to say Karen will be with us as well if anybody's got any specific questions. Happy to answer.
Yeah, brilliant. So we're going to 7 p.m. next Tuesday night. There's going to be an email probably go out today to the database about that, and you'll be able to register for that webinar, get your questions answered here from Wendy and Karen in detail about this aspect of their project. But I know you're very excited about it, Wendy. You've put a lot of time and effort into this. It's a big project, but I know you're sort of fully committed, fully engaged, and we look forward to being on the journey with you and hopefully helping you out, raise equity for your project.
Brilliant. Thank you. And thank you for all your help so far.
No problem at all. So, okay, just moving to wrap up then. Next week, we're actually, and I know John's going to really enjoy next week. He enjoyed this week, of course, but he's going to really enjoy next week because he likes planning and the whole idea of raising funds for planning projects. So next week, John, we're doing the current state of the planning process in the UK. We have 2 people coming on board representing companies that are preparing raises on the platform. So they're going to be explaining sort of why they got into planning, what they're looking to achieve through planning. We're also going to have Ed Morgan, no stranger to the platform. He's had multiple deals funded and indeed paid out on some of his deals. And he has actually just had a planning application approved. So he raised the funds on the platform. They covered the cost of the application. Application has now been approved. So it's going to be interesting to hear from him about that approval process, what barriers there were, what delays they were. But thankfully, he got over the line, and that project's going to pay out in the next week or so. And then he's bringing the development side of the project to the platform as well. So this is going to be interesting, John, next week, I think, regarding planning, because it's a hot topic given the challenges with so many planning departments.
Yeah, I mean, it's a paperwork exercise. It depends on internal council staff. It depends on your consultants, all the rest. Wendy's definitely been involved in some planning, getting to where she is, and then some future planning. So it's the core of how we're going to build more homes in the UK. And if people want to take part in planning, I think it's a very interesting way to invest, but you have to do your homework. And I definitely highly recommend that people never go all in any one deal, that they sort of spread their money around, because planning is a little bit of a subjective decision. Even if the majority of the applications are approved, 60-something% at most councils, it doesn't mean your application will get approved. So having a diversified view of it can help a lot.
Yeah, okay. No, thanks for that. I see a quick question, which we'll just deal with very, very quickly. So Wendy, you can get ready for a 30-second answer. Question is, if you were going to do it the other way around, commercial to resi, would you still need 2 years no trading, or would 3 months empty or not trading do?
I'm not sure how relevant that is. I suppose if you're doing commercial to resi, then you know, things like you only have to pay 5% VAT on the works potentially. And it really depends, again, what your intention is with the building, and that's what the lenders, I think, are probably more interested in.
Okay.
I mean, you're going to sell it off in that scenario, or you're going to refinance as a residential property. So you don't have to establish any history. You just have to get it built to the appropriate planning specifications and building control specifications. So yeah, it's a different beast because it's a different type of loan product.
Yeah. Okay. Thank you. We aim to educate, so hopefully that's helped. So yeah. So tune in next week to meet Ed, Mark, and Kat, and that will be interesting in terms of discussion. Okay, John, just get to your Ask John before we wrap up. Why is the British pound falling when the US dollar is rising, and what impact does a weak pound have on the property market, particularly here in the UK?
So it's sort of complicated. You could say the pound is falling because of Brexit. You could say the pound is falling because of energy dependence. The US has achieved energy independence again off the back of fracking. The UK doesn't want to use fracking. So when it comes to a global event like Ukraine and Russia and the whole disturbances in the gas market and the petroleum market, you have this issue that if you're energy independent, you can isolate it yourself from that. Second is energy tends to be priced in US dollars. So as energy prices spike, everybody's spending US dollars to buy that. Well, the US has dollars and everybody else has to buy dollars from the US. So essentially that drives up the demand for US dollars and drives down the value of these other currencies. The UK, up until a week ago, or last Friday, the UK sterling was doing relatively okay compared to many currencies other than the US dollar. As of last Friday, they sort of aimed the gun at their foot, blew it off, aimed it at the other foot, blew that one off, and then tried to blow a few more feet off. So now we have all this short-term market turbulence, and it's causing the government issue debt to rise. Well, when that happens, all the loans get repriced because essentially all mortgages in the UK are priced against the UK government bond market. And when that bond market has interest rates rising, all your interest rates are going to rise, and that doesn't have a positive impact on the property market. Turbulence causes people to stop doing stuff. After they start to get their head around it, they realize the interest rates are going to be higher for a longer term. Then they say, well, then I have to buy a smaller house. So you see generally downward pressure on values. Long term, as property investors, if you're in it for the income, all this stuff washes out and it doesn't matter. As Wendy said, as I didn't say, but I also have similar experience. We're used to higher interest rates than we currently have now. People still need places to live. There'll still be demand for housing. So take the long view, the 10, 20-year view, and this will just be sort of the comedy that you refer to with your grandkids.
Okay. And I like your analogy about blowing both feet off. I suppose the question is, from my perspective, and I probably see it slightly different than you, is there a need for short-term pain for long-term gain? So it doesn't happen that often, but there are occasions where a human being finds themselves trapped. Think of caving accidents where they've literally had to amputate a leg to survive. So whether the blowing off of the feet in your analogy is a short-term pain potentially for long-term stability, that remains to be seen, and we definitely can't sort that out on a 30-minute call. So just before we wrap up here, I was fortunate last week to be on the road back over in London. Did a nice podcast with Tyler Newman and his Newman Rose podcast, which I believe is out this week, I think. Tyler's got a fantastic apartment overlooking the Thames. I mentioned the Houses of Parliament at one stage, and then actually remembered you can actually see the Houses of Parliament from his window. So that was a good experience with Tyler. We attended the Canary Connections, Barry Ray's networking event that we sponsor. So it was great with Dal Ray, our investment portfolio manager, just meeting some of our fundraisers, some of our investors, and of course new people, which is great. We were over with AJ and the PLMD team, and he and his team, and actually Tyler Newman joined us to have some discussions about how we can improve the fundraiser process. So it was a really good brainstorming session, and Brenda was able to join the trip. It was nice when we arrived at PLMD and had a nice bunch of flowers for her, which I thought was a really nice touch. So a shout out to Jazz and the PLMD team that had that. So yeah, it was good to be back on the road and meeting people, and it's always good to get good feedback from people. Coming soon, Stafford Gardens is on the platform now, so you can visit the coming soon thumbnail and leave your details if this is a project you want to hear more about, and you'll hear from Mark next week on the broadcast. And the last slide, which is a really great news, we have successfully funded the second tranche of Newman Rose, 500,000 raised from 26 investors. So this is a successful raise. Not paid back to investors, just we've raised the funds to allow them to move forward on their project. The first tranche was 400,000. So John, we've actually raised 900,000 from the platform through a combination of mainly their investors and some of ours. So this makes it the largest deal on the platform to date.
Yeah, I mean, it was 2 tranches. Do you want to explain why?
So initially the tranche 1 was the equity slice that they needed on top of their own equity in the game. They were going to use a mezzanine slice as part of the capital stack, and then they decided against that and came back to the crowd for equity. So they felt that was a better one, that let more investors come along the journey. This is an education product for them, and let them open it up to, well, in this case, 26 additional investors are now on board the journey, and if you like, partnering with them on this project.
Yeah, so it's very important that you have flexibility, and they chose to use less debt, more equity, because it made sense for them and the project as far as they were concerned.
Absolutely. So that is us for today. Thank you very much, everyone. Someone did ask about the YouTube channel. So if last week's isn't up, I'll double check that. It should have been up, but I'll make sure last week is up, and then this week will be up within about half an hour. So you can, of course, watch the recording on our YouTube channel. The URL is on the screen there, just youtube.com/Leo crowdfunding will take you direct to our channel. And of course, there's so much else there as well. So Wendy, thank you very much for joining us today. Really appreciate that.
Pleasure. Thank you for having me.
Thanks again, John. See you again next
See you.
Thursday. Bye. See you all. Bye-bye.
Bye.